Guys, Freaky Finance here. Today we're going to do Disney and Brookfield really quick, another two that I own that reported this morning. Quite a few names that are fun this morning, especially JDU is interesting. We got AST tonight, which will also be moving in one direction or the other. Anyway, let's jump into Disney real quick. Before I do, I just want to show that I do own both of these. So I own Disney, 540 shares on it as a CDR again on the Canadian side, and then Brookfield also on the Canadian side, about 15k, 82% now. Wow. And we'll go into both these really quickly, just the thinking behind them. Disney was more of just what's playing out. We just knew that streaming would stop being so bad for them. That's pretty much the gist of it. And Iger's done some things which have increased EPS over time. All right, so let's jump into it real quick here. I'm going to try to keep this tight as possible. So Disney, we've talked about it before, has three main segments: entertainment, sports, and experiences. So entertainment has linear, and it also has your streaming. It has your entertainment, like your theatrical releases, your movies. Sports, the ESPN, it gets all the attention. You can see how small it is relative to this overall business, but it gets all the media attention. Not like it's not big, it's just small relative to the other ones. And then you have experiences. So that's your parks and cruise lines, stuff like that. And you can see overall the main place of growth, at least this quarter, is entertainment. And that hasn't been the case for a while because entertainment has linear networks, which has been the shrinking ice cube, right? There's a reason why all these creators are going online streaming, right? Making their own platform like Disney Plus and Paramount Plus. There's a reason for it because linear is going away. The attention, the eyeballs on the platform are shrinking, so the ad dollars are shrinking. At the same time, the ROI isn't as great as it is for digital advertising because digital advertising is getting better every single year in terms of its efficiency. So anyway, a whole lot of reasons to go into why they're doing it and why are we in it now. So we've waited for this investment period to be over, and you're starting to see segment operating income shoot up over 100% year over year, almost 4x year over year. The reason why is because really it's just DTC, so the direct to consumer, the online streaming platform, finally stopped being horrible. They raised prices, they pulled back production, and at the same time they didn't lose too many subs doing it. They actually still grew subs year over year. So, and that's what the market wasn't sure about. They're like, well, if you pull back production, aren't you going to lose eyeballs, increase your churn? And while the growth rate slowed for additional subs, it didn't lose any, and it also was able to increase prices at the same time. It cut back on production. Iger actually cut 3% of the workforce in February 2023. And we'll just jump to financials really quick here. So balance sheet, you can see they've been using a lot of cash. Iger tends to be more aggressive with his cash. What I mean by that, he'll more aggressively pay down debt, and then he'll also more aggressively buy back shares. And he also started the dividend again. So he's done a lot of things that are shareholder friendly. It's kind of been his history. And he does hard decisions, right? Like cutting 3% of the workforce for Disney isn't exactly popular because it's seen as such a happy place, right? But the reality of it was that they were overproducing content and there wasn't enough eyeballs to go around for the cost they were spending. So in my mind, they've done rational things, which I agree with. Here you can see borrowings, 38 billion, with another 6 on the current, so around 45 billion versus around 45 a year ago. So, I mean, they have started to pay down debt. It's just there's a lot of debt to go down. You can see that the capex for attractions, buildings, and equipment is still pretty high, right? You're up 6 billion year over year, and that's with 3 billion being depreciated in a single year. So a lot of these parks are very capex heavy. Cruise ships are capex heavy. So a lot of the cash flow actually goes back into the business of Disney. What they're doing with the cash, so it's not like the business hasn't improved. Like I said, losses have finally, but it's actually, streaming is now profitable. Disney is actually profitable, which for Disney Plus is special, right? That wasn't the case a year ago. And definitely not 2 years ago. But anyway, you can see CFO improve, and you can see CapEx creep up. So make 14, put 5.5 back in the business, right? But also make acquisitions, and then you have the shareholder remuneration. So you can see some debt pay down over time, but more importantly, you can see with Iger, at least for our point of view, they're buying back shares and they have reinstated a dividend. Now it's not quite the same dividend it used to be, but you can see that these shareholder-friendly things have started to show up. In terms of entertainment, again, the biggest segment for Disney, you can see linear is shrinking in terms of revenue year over year, is shrinking again in operating income year over year. And again, that's the shrinking IQ part of the business. You keep seeing lower impressions reflecting lower average viewership, right? You see programming costs continue to increase, right? Because of inflation. So basically, linear networks continues to get squeezed. Even while they're trying to cut costs, it's just a shrinking ice cube, right? You have less viewers, and your cost to produce content goes up. So it's a rough environment in a linear. So you've seen pressure. I mean, we did Paramount videos a few times, right? We've been in that a few times. And Disney, WBD fits this category too. But more importantly for Disney, it's ahead of the other two in terms of direct to consumer. Part of that is because they were one of the first to raise prices. They've also been more aggressive in their sub. When I first started, they were very aggressive in their sub count numbers, with including Hotstar India, which we talked about like 3 years ago. Anyway, we're seeing direct to consumer get better, so not only seeing lower marketing costs, but you're seeing increase in advertising revenue, and you're seeing increase on the also taking price, right? They raised the sub what it costs to be a sub for Disney Plus. So overall, you're seeing the loss swing from losing 400 million to making 300 million, right? That's not a bad swing year over year, right? And it's totally offsetting the decline in linear networks. So it's starting to see DTC actually more than offset the decline in linear networks, which is exciting. And that's the first time that's probably happened. Anyway, here you go. You can see the sub counts slowly go up. The ARPU is actually flat to down year over year for domestic, which is interesting. So they need to probably raise price again, because this is a very low number, especially relative to international. Usually you see a bigger spread in US and Canada versus international, so I'm kind of surprised. Now this could be because a lot of domestic, it could be the ad load, like the ad supported platform is bigger in domestic and international is more sub heavy. But it's just interesting to see these two be so close, because we've seen other companies, and normally US and Canada pay a lot more than whatever is the average internationally. Here you can see the swing. It just shows up like a sore thumb, right? Losing 400, making 250. So that's a nice swing of profitability with only 15% revenue growth. So just way more efficient on the Disney Plus side. Definitely pulling back content at the same time raising prices. And you're seeing how it's working. And here's a more visual chart just to show the trend. This is peak losses. And they did say this was going to be peak losses this year. And then they're going to improve in 23 and then improve again in 24, which they have. So now they're finally in profitability. So we'll see what they're going to do in 2025. But it basically means that they've offset the shrinking ice cube part of the business finally. Parks, we don't really need to talk about too much here. It's been kind of flat. If you look at the numbers, they've been relatively flat. It's actually the only thing that's kind of declined is international, which are flagging lower volumes to lower attendance. So, and they're actually seeing lower spending per capita, which wasn't the theme probably 2 years ago or a year ago. So that's interesting. So we're starting to see some pullback on experiences, and Disney's higher end, and we have seen a pullback on the higher end consumer, right? So anyway, it's worth bringing up here because that is the second biggest segment of Disney. Another thing to point out here, just for fun, if you want to look, you can see consumer products. Well, it's slow in revenue. It's actually very high in margin, right? Selling 1.1 billion worth of merch and making 500 million on it. That's a lot higher margin than say the parks experiences, right? So it's worth pointing out if they can keep getting. One of the things they've done very well over time is expand the merch product line for Disney. There's a lot of goods out there that are Disney orientated. So it's worth pointing out. And then for the next little bit, and that's probably something I'm going to think about in 2025, early 25, is thinking about taking some profits on the trade, is because this is the part where we had the strike last year. So there was not a lot of content out at the end of, like, around Christmas time last year, and even for most of Q1. So we have that they're competing against. So you're going to see theatrical still put up numbers like it did this quarter. It should have put up really good numbers, partially because of Deadpool and Wolverine. But you're seeing the comp is also very easy, right? Like last year they only had Haunted Mansion. So this year they have Moana 2, Mufasa. They have a whole bunch of stuff, right? Captain America coming out. So stuff that's probably going to do better than what last year was, because they had a strike that they were still dealing with, which impacted production. So that's about it for Disney. I mean, what I like to look for again is when people are reacting to cut, like to slow down, so it makes a hard decision to reduce headcount. At the same time, we knew losses were improving, right? That was the trend, and so it was a relatively easy entry to pick up some Disney. Doesn't mean that it's a great idea. It is still relatively expensive for what it is relative to say the other streamers, um, which are likely to do the same thing, just follow it at a slower pace. Brookfield, on the other hand, has been amazing. This company, it's hard to find asset managers that do the job probably better than what I could do. And I think Brookfield's one of them. At least they're more consistent. My ideas can go all over the place. Some will go up 400%. Some will just get cut in half, right? I'm getting better, I think, as I age, but Brookfield is special, and I also like just to own them because I like reading the shareholder letters, right? And basically, what they're saying here is they're seeing an increase in transaction activity, and that's good for Brookfield because basically they buy and sell stuff all the time. They wheel and deal all around the world in a lot of different things at a lot of different times. I can't go into all the details of Brookfield because it's too big. It's like I remember when we did the video on Power Corp. It's like Power Corp on steroids. It's Brookfield Corporation. But we do own Brookfield. They are seeing, like I said, an increase in transactions. So you're seeing a lot of good ROIs here. So 30% IRR, 2.2% multiple capital on this deal, right? You're seeing these very high 25% IRR, multiple capital 2.5 times, right? Just wheeling and dealing. And this is all over the world, right? And this is another 22%, 2.2 times multiple capital. So just they're doing very well with their investments over time. And then they also had the 3Ds, right? Deglobalization, decarbonization, whatever the other one was. And they've just done so well with this line of thinking, and they called the top of interest rates very well. They've done everything very well. And the thing that I really like, the reason why we got the opportunity to buy it when we did, is it was facing a lot of headlines from Brookfield, the largest public real estate company, is defaulting on these office properties, and that's all we saw for 2023. And so when we looked at the financials, right, just to give you some context, this is current financials, but back then it wasn't as good. And anyway, property you can see is only say 700 million out of 4.5, but it was getting all the headlines, right? All the headlines. It's everything Brookfield, office. And I was like, office isn't even that big in Brookfield. Like it is big overall, but in terms of Brookfield's umbrella, it's relatively small. And you looked at the properties, and most of them are higher quality with occupancies over 90% anyway. So it's kind of like, okay, so they're just sniping ones, and that put a lot of pressure on the stock. These type of headlines, and that's what I look for is like things. So that was in April 23, right? You can see it's kind of lows in March, lows again in October, and this company like has a better track record than I do in allocating capital. so um, and so I was like, okay, this is probably an easy time to buy, and it turned out to be correct. So longer term, this company you can see is really strong. It does go pull back with the beta in the markets with recessions, um, but every time it's probably been a buying opportunity because these guys they know what they're doing. And I just like following them and owning them partially because they put up numbers probably better than I do, and I also just it keeps me forced to look at the shareholder letter and tell me what's currently happening, right? So basically, they're saying things are improved, and I think 2025 is going to look even better um, in terms of deal flow, partially because rates are starting to come back down, so things are starting to move again. Because property was relatively frozen for a while there. I mean, especially office property. But anyway, I'd like to know your thoughts on Disney and Brookfield, and have a great rest of your day.